In this, the 28th lesson in the course, A Critical History of Economic Theory and Policy, we hear economists finally discussing the fact that the policies they advocated based on accepted economic theory were not working as anticipated. John Kenneth Galbraith, one of the architects of the liberal economic programs that were adopted following the Second World War, advised his readers in 1977 that they were entering the age of uncertainty. Galbraith observed that all that had been done to advance the cause of equality had hardly made a difference. He wrote, "People of privilege will always risk their complete destruction rather than surrender any material part of their advantage. Intellectual myopia, often called stupidity, is no doubt a reason." President Carter decided to replace Arthur Burns with G. William Miller as chairman of the Federal Reserve Board. Then, in July of 1979, Miller was moved to the Treasury, and Paul Volcker took over at the Federal Reserve. At the urging of Milton Friedman and other monetarists, the Fed abandoned its long-standing strategy of trying to manage interest rates in favor of achieving a slow, steady increase in the money supply. In an interview he gave in 2000, Volcker explained the rationale behind the measures he pursued. "I certainly thought that inflation was a dragon that was eating at our innards, or more than our innards, and if anybody was going to deal with this, it was going to have to be the Federal Reserve. We set out to draw some kind of a line in the sand about how much money and credit growth was appropriate. In doing so, the effect was to push interest rates up in the short run because people were expecting inflation. They were perfectly willing to borrow. It was a good thing to borrow when you expect inflation, and the borrowing came up against a limited supply of money and credit. Interest rates were way up, and sooner or later that was bound to have an effect on the economy. It did, and we had a severe recession. But we came out of that recession with a very strong movement called price stability, and also with strong economic growth." Volcker was not particularly sympathetic to the monetarist ideas put forward by Milton Friedman, but he accepted this shift in policy to achieve other objectives. Robert Kuttner, co-editor of the American Prospect with economics credentials from the London School of Economics, explained in 1991, "It provided an exquisite camouflage for the austerity program that he believed was the only solution to the twin problems of stagflation and the dollar's free fall. Freed of any constraints imposed by the Federal Reserve, interest rates climbed and kept climbing. The result was a major tightening of credit, as few businesses and even fewer consumers could afford to borrow at double-digit rates, particularly for residential properties and other types of property affected by already high land prices. The asking prices for newly constructed buildings started to fall, as builders needed to move unsold inventory in order to repay construction loans. Owners of existing residential properties, for the most part, simply pulled their properties off the market, waiting for demand to return. Of course, some owners were forced to lower their asking price because of personal circumstances. Despite the softening property markets, real interest rates were low and falling in response to the declining value of the U.S. dollar. Property owners with fixed-rate mortgage debt were repaying loans with money that purchased much less than when borrowed. Those with high disposable incomes and financial reserves shifted into collectibles, into land, real estate, and precious metals. As 1980 arrived, the United States economy drifted into an acknowledged recession as stagflation actually worsened. Economist Herman Kahn, examining the Carter administration's record, suggested intent over accomplishment. Kahn said, "The Carter administration in its last year became concerned with reindustrialization of the U.S. They envisioned a kind of coalition between management, labor, and government, all working together in a harmonious consensus to increase productivity and to improve the operation of the American industrial system." Carter and his team of economic advisors would not get the chance to adjust their economic policies to meet the challenges of an interdependent global economy increasingly dominated by multinational corporations capable of moving operations around the world to whichever location enabled them to maximize revenue while minimizing the costs of regulatory compliance, environmental protection, wages and benefits paid, and of course taxes. Calls for the reindustrialization of America abounded. However, this could not be achieved without systemic changes that were certain to be imposed by deeply entrenched special interests. Worse yet, neither economists as a whole nor political leaders understood just what systemic changes were needed. Everywhere one looked, the U.S. economy seemed to be becoming unglued. During 1980, gold reached $875 an ounce. Inflation hit nearly 15%. Unemployment worsened. Skyrocketing land prices during the decade translated into a doubling of mortgage debt from 1975 to 1979 to over $750 billion. By year end, oil reached $40 per barrel, and by this point, roughly 45% of the nation's oil consumption was dependent on imports. Ronald Reagan entered the White House holding specific beliefs regarding the keys to economic growth. He came to embrace what, in his view, were true conservative economic values, policies that return responsibilities to the states and lessen the burden of federal taxation on citizens. After defeating Jimmy Carter, Ronald Reagan delivered his inaugural address in January of 1981. Of the nation's economic situation, Reagan said, "These United States are confronted with an economic affliction of great proportions. We suffer from the longest and one of the worst sustained inflations in our national history. It distorts our economic decisions, penalizes thrift, and crushes the struggling young and the fixed-income elderly alike. It threatens to shatter the lives of millions of our people. Idle industries have cast workers into unemployment, causing human misery and personal indignity. Those who do work are denied a fair return for their labor by a tax system which penalizes successful achievement and keeps us from maintaining full productivity. But great as our tax burden is, it has not kept pace with public spending. For decades, we have piled deficit upon deficit, mortgaging our future and our children's future for the temporary convenience of the present. To continue this long trend is to guarantee tremendous social, cultural, political, and economic upheavals." The economy he inherited was dysfunctional, but Reagan's diagnosis was flawed. In the end, his decisions pulled the United States deeper into its recession and then triggered a prolonged period of debt-financed speculation in the property and equity markets. Back in 1981, just as I was beginning to write regularly on economic matters, I raised the following question in the quarterly newsletter Equal Rights, published by the Henry George Foundation of America. I wrote, "The one question I have not yet heard addressed by the supply-side economists is the method to be utilized for control over monopolistic appropriation of any increases in productivity achieved. I am quite positive that the member nations of OPEC and our own domestic corporate resource owners do indeed have great expectations for the Reagan plan. Ronald Reagan came from California, where Proposition 13 became law in 1978. What Proposition 13 did was to roll back property values to their 1975 assessment, then limited annual increases in assessments to 2%, regardless of the actual increases or decreases in market value. When a property changed hands, however, the buyer's property tax payment became based on the current purchase price paid. Thus, owners of property of equal market value were taxed very differently. California's fiscal condition began to deteriorate almost immediately. Reagan personally benefited by Proposition 13, having purchased a 688-acre ranch estate near Santa Barbara in 1974 for $527,000. The Reagans sold most of the ranch, then converted the balance, about 200 acres, into an estate overlooking the valley and the Pacific Ocean. University of California economics professor Mason Gaffney anticipated the side effects of Proposition 13. Gaffney wrote, "On balance, then, it seems that California will suffer a substantial decline in its economic base, which, in a few years, will cause the state either to sink into an Alabama-like desuetude or to repeal Proposition 13. Proposition 13 has not been repealed, however. In 1995, Mason Gaffney revisited the impact of what he still viewed as a disaster for Californians. In 1978, we had a surplus in Sacramento. Since then, we have raised business taxes, income taxes, sales taxes, and gas taxes, but go broke every June. Now our state bond rating is last among the states. One of our richest counties, Orange, has gone bankrupt. Los Angeles is on the brink of it, saving itself by closing emergency rooms and hospitals that serve as the last resort for the uninsured poor. Proposition 13 aside, the nationwide recession had little effect on the rapid climb in land prices. Circumstances were ripe for the land market cycle to begin anew as interest rates began to fall in 1983 and for a modest recovery in new housing starts. Another serious contraction came in 1989, triggering the savings and loan crisis, after which land prices and housing starts climbed once again, reaching a new high in 2007. Landowners who held their land free of mortgage debt almost universally experienced low annual property taxes and simply kept their land off the market, waiting for demand to return and prices to once again climb upward. Acquiring and holding on to land banking, was promoted as an essential financial strategy. The advice from Samuel Clemens remained as true as in his time. Buy land, they don't make it anymore. Importantly, for purposes of economic analysis, the federal government was no longer gathering data and reporting on these trends. Government data covered only the period through 1968. Even so, the 1980 report by Robert Eisner should have provided some clues to other economists. Eisner stated, "New revaluations in land were positive in each of 5 sectors for all the years 1953 through 1968 for which data were available. The value of land rose from $201 billion at the end of 1952 to $726 billion at the end of 1968. Despite periodic and regional crashes of property markets, the rental value of land continued to drive the U.S. economy. The Reagan years were no exception. By 1980, the median residential property price in the United States reached $47,200, a 277% increase from the 1970 figure of $17,000. A rough estimate of the total value of all residentially developed land in 1980 can be made as follows. Assume a 30% land to total value ratio, and we see a median land value of $14,160. With 52 million homeowners in the nation, the total land value they held was $736.3 billion. Owners of properties leased to renters held an additional $423.6 billion of land value. A report issued by the Brookings Institution at the end of 2000 provided some interesting statistics on land uses in our larger cities. Brookings found there were some 780,000 vacant structures throughout the U.S. On average, 15% of the land of every city was vacant. Land parcels remained vacant because of small size or odd shape, because the parcel was located where demand was low, or there were problems with ground pollution. More often than not, well-located land parcels were being held for speculative purposes, driving up the asking price of other tracts of land put on the market. Remarkably, funding for gathering data on commercial land values in the nation's cities was eliminated during the Reagan years and has not been reestablished. In 2007, Morris Davis, former Federal Reserve economist, then University of Wisconsin-Madison professor of real estate and urban land economics, wrote, "The U.S. government does not collect data on either commercial land or residential land. As far as I know, we have no good data on the price or value of land used for commercial purposes." Without accurate, up-to-date statistics on the United States and global land markets, uncertainty was unavoidable, and constructive changes in public policy difficult to achieve. The Reagan team would now have 8 years to place a permanent stamp on U.S. economic and domestic policies. At the same time, Reagan was committed to outspending the Soviet Union on the military until the Soviet economic system collapsed. We reached the end of Lesson 28.